Hello, everyone. Today we'll be talking about the fair value through net income method, or FVTNI method. Now, when do we use this method? We use it when we have no significant influence. Um, so if you had significant influence, which is 20 to 50% of the voting stock, I know that's voting stock, you would have used the equity method. But suppose you have less than 20% ownership of the voting stock. That is when you would use this fair value through net income method. So first off, let's go over some journal entries. Suppose you go out and you purchase this investment. Now, what's the journal entry for purchasing an investment under the fair value method? Well, a lot of these journal entries, something to note is you'll be influencing the investment in equity securities account a lot. That's an account that goes in the assets under the balance sheet. So first off, what you do is you debit this investment in equity securities account. It's an increase to an asset on the balance sheet. And then you would credit cash. This is the amount that you paid for the investment. Keep this account in mind. It gets used a lot in a lot of these journal entries under fair value method. And then when dividends are declared, this is not when your dividends are actually paid, but when they're actually declared, then it becomes something that you've essentially earned and you will eventually receive. So what's the journal entry for that? You would debit an asset called dividends receivable. That's an asset on the balance sheet. And then, because you're hitting an account on the balance sheet, you've got to hit an account on the income statement now to balance that out. And what's that called? It is called dividend income. Now, as I'm going through all these journal entries, remember this is just for the fair value method. Once we go through the equity method, completely different ball game, and a lot of these journal entries won't be applicable. So something to note is that fair value through net income method is also called the mark-to-market method. So what happens is every time you have a new balance sheet date and there's a gain or a loss, that unrealized gain or loss, note that it's an unrealized gain or loss. So you have not sold these investments yet. You have to mark this fair value through net income investment to market, aka the fair value. So here's an example. We're going to go through unrealized gains and losses. So unrealized, that's when you haven't sold it yet, but there's a gain or a loss. Gains or losses. Let's start off with the journal entry for the gains. And that's going to be, again, this investment equity securities account gets used a lot under the fair value through net income method. So guess what you're going to increase? That's right. You're going to increase that investment in equity securities account directly. That's increasing an asset on the balance sheet. And you are going to credit, what does this sound like? Unrealized gains or losses. So that account is unrealized gains or gains, which is going on the income statement. And then the opposite of that is if you have an unrealized loss. So as opposed to crediting a gain here, you would debit an unrealized loss. And you would credit the investment account. All right, so moving on from that. Um, so suppose now, since we talked about how we acquired this asset, what if we want to dispose of it? What is the journal entry? Well, there's two ways you can kind of go here, depending on whether you have a gain or a loss on disposal. But the journal entry is really straightforward. Again, that investment equity securities account gets influenced. So suppose we want to dispose under fair value through net income for these investments. right? We're going to dispose of it. We're going to sell it off. Let's see how much money we get. So first off, we debit cash for however much money we receive. I'll skip a couple lines down on this journal entry. So we know we're going to credit that investment in equity securities account. And that goes down. This is also an asset on the balance sheet. And then depending whether you have a gain or a loss, it's going to fill up the space here. So what would you debit? You would debit a loss on the disposal to fill in that gap. Now that kind of makes sense because if the investment is worth a lot more, suppose it's like $1,000, and then you only got maybe like $300 for it, how would you fill in this gap in the journal entry? You would debit that difference of 700. And then let's invert that. Suppose that you had a gain on disposal. So same situation here. Let's suppose that you received $1,500. Your investment in equity securities is only worth $1,000. So to fill in that gap in that journal entry, you're going to need a credit here for the gain on the disposal. That would be great. We'd have a $500 gain on disposal here. So something that trips me up a lot for the fair value through net income method, and it's sure to get you on exam day as well, is how do we treat the investee's earnings? Now, under the fair value through net income method, we're not going to adjust that investment count. So think about that. Under the fair value through net income method, we are not going to adjust the investment account. There's something that's going to be listed here. We only do the journal entry that we had previously above, which is this one. If we have unrealized gains or losses on the balance sheet date, so on the balance sheet date, this is mark to market. If we had a gain, we debit investment in equity securities, we credit unrealized gain. If we had unrealized loss, we debit the unrealized loss and credit investment in equity securities. But if the investee has net income, we are not going to make a journal entry for that earning. So investee's earnings, no journal entry. Don't do it. Don't do it. Right. Okay, but what if the investee declares a dividend? Oh, we talked about this earlier. So the dividend declaration journal entry was already up here. If the dividends were declared, we'd have this journal entry right here. Debit dividends receivable, credit dividend income. What's the inverse of that if you were to receive this income? Well, so for dividends actually received, yay, we're getting paid out. Obviously, they're going to give us cash, so we debit cash. And then we have to reduce the dividends receivable. Okay, that's easy and straightforward. Let's see, anything else do we need to cover? Oh, something to note. Suppose that the investee pays dividends, but we get more than we expected. It's more than our current or retained earnings. Then this journal up here, this dividends receivable, dividend income, this journal entry gets tweaked just a little bit. Let's see if I could fit it. Let's pick a different color. Let's fit it maybe up here. Oops, my color switch didn't happen. All right, I'm gonna try to write it real small up here. So very, very similar to this declaration for a dividends journal entry. So these are declared dividends. But suppose we receive an amount that is more than our current more than the current or retained earnings. Um, what are you going to do is you're actually going to squeeze in another line right here. So the investee is paying out dividends, but it's kind of eating away into the investment equity securities at this point. So you're actually going to reduce that asset on the balance sheet. All right. Okay, what else do I have to cover? Give me a moment to go through my notes. We've gone through the unrealized gain and losses. Um, so something just to note, stock dividends and stock splits. Um, this is just a good general thing to know when you're studying for the exam because it's treated kind of the same way across all kinds of investments. Stock dividends and stock splits get treated retroactively. So it's as if it had always happened. And while they increase the number of shares that are issued and outstanding, it doesn't increase the overall amount that those shares are worth. For example, you might have a 2-for-1 stock split. Oops. So suppose your investment is like $5,000 spread over 500 shares, and there's a 2-for-1 stock split. What does it matter to you? It actually doesn't. That $5,000 stays the same, but now every single one of these 500 shares has become 2 shares instead. So now that $5,000 is spread across 1,000 shares instead of over the 500. But your overall investment still stays the same. So while the numbers of shares increase, you're not going to have any change in the journal entries. Oh, good point. Let's talk about how we treat these. Let's do a color change. Let's go through how we treat these on the financial statements. So just our basic financial statements, balance sheet, got A equal L plus SE, income statement, revenues, expenses, gains or losses, and then the statement of cash flows. This one seems to be the one that trips up people the most. Just gotta remember where all those categories go. So first off, let's talk about the balance sheet. Investments are treated a variety of ways. They can be either a current asset or a non-current asset. Now, what's the general rule for that? Remember from your accounting 1 class, it depends on whether you want to hold on to this asset for a year or the operating cycle, whichever one is longer. So 1 year or 1 operating cycle, whichever is longer. And then for this operating cycle, they go over examples in your accounting 1 class. Let's say you have a seasonal business, or maybe you have an asset that is being built over the course of 3 years. Just to get it from when you first initiate creating that asset to when you actually sell it, it might be an operating cycle that lasts for more than 1 year. So it depends, is the short answer. All right, that's how you treat the investment in equity securities as fair value method. Under the income statement, suppose you had a multi-step income statement. Scroll a little bit. All right, you know what? Let's just go through the multi-step income statement because that's going to help you a lot in the exams as well. So start off with sales, what we take away from sales, cost of goods sold. Here you've got sales as an S, cost of goods sold, also an S, gives you gross profit. If you can remember from economics, that little pi symbol, not just 3.14, it represents profit under economics. That's just a nomenclature for it. And then you subtract operating expenses. Basic costs of operations, whatever keeps the lights on, SG&A, accounting costs, of course, you go under operating as well. And then what happens when you take gross profit minus operating expenses? That's right, you get operating profit. And then once you go through operating items, let's think about items that go into non-operating. So these are things like your investments, any dividends that you earn. So does that sound a little bit familiar? It should. Our investments and our fair value through net income method, these should go under here. So any dividend income you earned, unrealized gains or losses, always go under the income statement as well. And then scroll down a little bit more. Like in the final journal entry, when you actually dispose of it, you're also going to have gains or losses that go underneath here. Let's talk about the statement of cash flows. This used to be one of the most difficult topics for me, but now once you get things rolling in your head, it becomes like one of the easiest topics to just remember straight up. So you could have a couple of different options for things that go under here. Just listing out a couple of them. So when you buy the investment, when you sell the investment, and when you get dividends, basically for the statement of cash flows, think about all the ways that money flows in or out of the business. So that happens when you pay cash to buy the investment, when you sell off the investment, and when you receive dividends. So dividends received, we've got three options here. Let's go through that first. Cash flow from operations, cash flow from investing. So that's investing in your own business or buying the stocks of another business. And cash flow from financing. What's financing? It's when you take out loans or find ways to finance your operations. Maybe you don't have enough cash in hand, so that's how you find your funding. I'm gonna make sure that looks like an I. So dividends received. Where do you think that would go? Right. So dividends received. Remember that is cash flow from operating activities. As opposed to if you were to pay dividends. Suppose you have your own stock and you put it on a public stock market for sale, like the New York Stock Exchange. Dividends paid would be a financing activity. But here, dividends received are part of cash flows from operations. It might actually help to think of this like also if you have like a bank account and you get interest income. Not that it's applicable to this investment example, but like I like to think of interest income and dividend income under that same boat. It just kind of helps me remember. I do the bank reconciliation on a day-to-day basis. So interest income under cash flows from operations, dividend income goes under there as well. When you really think about it, it doesn't really belong in the other categories. You're not issuing your own stock or taking out loans, so it's not financing. You're not investing in another company. So while the investment itself, okay, while the investing itself, these are cash flow from investments, but the selling and buying of the investment itself, the dividends received are separate from that. These are cash flows from operations. So if you sell investment, what is it? Cash flows from investment, investment, investment. Easy to remember. And it's an inflow because you're selling it, you're getting money. As opposed to when you're buying it, cash flow from investing, your cash goes down. Your dividends received, cash flow from operations, money goes up. All right, so that's all I've got for the fair value through net income method. Hopefully that helps you when you're studying for the exam.